Hello, I'm Sean Rickerby of Rickerby Wealth Group at TD Waterhouse. In this, our third segment about bonds, we will look at some of the things that may affect the price of bonds in the market. First, we should take a look at the quality of different bonds, as investors want to be reasonably sure that they'll get their interest payments on time and their principal back at maturity. Bond issuers rarely publicize their credit ratings, so investors should ask their financial advisor. Here is an explanation of the rankings provided by Dominion Bond Ranking Service, with a AAA credit rating being the highest credit quality, AA rating for superior credit quality, all the way down to a D rating for bonds that are both in default of principal or interest or both. Here is a sample of interest rates from different quality 5-year corporate bonds. As you can see, a company with only a satisfactory rating must pay 5.31% or about a 0.5% higher interest rate than a AAA company to attract investors. Let's compare these rates to the current rates on Government of Canada bonds, which has one of the highest credit ratings in the world. As you can see, the Government of Canada pays less than half the amount a highly rated corporation would pay. Let's go back to the corporate bonds and take a look at a 20-year bond. The yield for a AAA rated bond moves from 4.85% for 5 years to 5.8% for 20 years. The message is, the longer we want to invest, the higher the rate of return that we will expect. In an inflationary economic cycle, an investor wants to earn a higher rate of interest if his money is tied up for a longer time, as he believes that everyday items will cost more in the future than they do today. Inflation occurs when prices rise because there's too much money in circulation and not enough goods and services to spend it on. When prices go higher than people are willing or able to pay, demand decreases, prices begin to fall, economic growth contracts, and we have a recession. As both inflation and recession are recurring phases of a continuous economic cycle, governments and banks change their monetary policy to try and level out these cycles. This next chart shows the yield on a 10-year US Treasury bond over the last 112 years. As you can see, we are very close to the low reached back in 1941. The importance of the current low yield environment is that governments and corporations have taken advantage of these abnormally low rates to issue long-term bonds. Over the 40 years following the 1941 low, the yield climbed to over 15% by the early 80s. If rates were to move back up, investors should expect to see meaningful downside in the prices and values of their current bond holdings. Since the US Federal Reserve has committed to keeping interest rates low right through to the end of 2013, we likely have some time to go before we see a meaningful decline in the price of government bonds. At some point in the coming years, however, bond yields will start to slowly move higher, and the 30-year bull market in government bonds will come to an end. In summary, interest rates on safe government bonds have reached extraordinary lows, and we are very hesitant to buy government bonds at this time. However, that is not to suggest that we should avoid bonds completely, just that we should consider shorter-term corporate bonds rather than government bonds at this time. At some point in the year ahead, as we go through the business cycle, we will perhaps reverse this approach. Up until now, we've used the generic term bond to describe both bonds and debentures. But let's discuss the difference between a bond and a debenture. A bond has a specific asset that secures the debt. A debenture is an unsecured liability. It's like the difference that exists between you having a mortgage on your house versus an unsecured line of credit. So a debenture is a higher risk than a bond, but nonetheless represents a debt obligation that has to be paid, that has to be honored. Before we finish with bonds, there is another type of debt instrument that provides some of the upside potential of stocks whilst having many of the safety and income characteristics of a bond, and that is convertible debentures. Convertible debentures possess a special right that allows the bond investor to exchange his bond into the common shares of the company at a fixed price for the life of the bond. Similar to a normal bond, they have a fixed interest rate and a set maturity date. However, they also offer the possibilities of capital appreciation as they can be converted to common stock at the holder's option. The addition of a conversion privilege makes a convertible debenture more saleable. While we hope to experience a success in the company's stock price, but it is not a requirement for us to still make money, and would be considered a bonus should it occur. Convertible debentures provide the higher income and comfort of a maturity date, whilst providing the opportunity for some capital appreciation. So that wraps up this segment for today. Please come back and watch some other segments. This is Sean Rickerby of Rickerby Wealth Group at TD Waterhouse. For more information, please call us at 604-482-5188 or email me at sean.rickerby@td.com.